going to discuss Chapter 5, Measuring the Outcome of Properties and Liabilities Insurance. First of all, we need to know the purpose for preparing the outcome of properties and liability insurance, providing information for users, whatever, for measuring the profitability or determining the financial position for the insurance company. The following income and expenses statements are prepared at the following schedule. Statement of income and expense for the insurance department against fire. Statement of revenue and expenses of insurance department against risk of land, river, and maritime. Statement of revenue and expenses of the insurance department on aircraft. Statement of revenue and expenses of auto insurance, which means car. Statement of revenue and expenses of the engineering insurance department. Then the statement of revenue and expenses for the insurance department, petroleum insurance department. The final step is the statement of revenue and expenses of insurance department against various accidents and liabilities. The first and the most important part in the income statement, or what we call the revenue and expenses statement, is the provision. We have three different types of provision. The first one is provision for potential risk. According to Article 37 of Law 91, the provision of potential risk at the end of the accounting period against the company's obligation, or we call it the claims, in return for insurance operations that have concluded its policies or premiums during the period. These policies will apply during the current period or the following accounting periods. Such a provision shall be reserved from the accounting period based on the percentage from the total subscriptions or premiums of the company for the ended fiscal year. The percentage determined by the law are the following. 47% of the potential risk should be concluded for the civil liability arising from car accident. 40% of the risk operation or other operation, 100% for the long-term insurance policies. These percentages are fixed. Whatever the potential risk, you have to use these percentage. The second type of provision is provision for the outstanding claims. Such a provision is generally for the accidents already occurred and have been notified, and the procedures which made by the company are not ended until the end of the accounting period. This provision is generally for the accidents that have occurred and have been reported, and the actions taken by the insurance company to pay the damages or the claims or the compensation or risk in respect of them have not ended until the end of the accounting period. The last type of provision is the provision for adverse fluctuation. This provision for undesired or risky fluctuation in the insurance market. Keep note that revenue for the accounting period is borne by the amount of technical provision that insurance experts deem necessary to form, which means that technical provision is part of the revenue, should be enclosed in the revenue part. While provisions for ending technical provisions are considered as the opening technical provision at the end of the next accounting period, are returned to the revenues of last year, where the revenue is its source and then it is closed in the revenue and expense account in the next year. While the ending technical provision should be opened in a ledger and accounted and disclosed in the budget of property and liabilities department. When the balances of the opening and ending technical provision for one of the financial periods are linked between them, their effects on the outcome work is determined according to the following consideration. Number one, if the balance of the ending technical provision is equal to the ending provision, then they have no effect on the income statement. If the balance of the ending provision is less than the balance of the beginning, the effect on the outcome work of the accounting period is positive and vice versa. Let's apply the following rules. On 30 of June, the insurance expert in one of the insurance companies working in the field of property and liability insurance decided to create the ending technical provision as the following. Provision for possible risk 300, provision for outstanding claims or damages 240, provision for adverse fluctuation 200. If you know that the balance of the beginning provision were the following, 400, 200, and 180 respectively, required, make the journal entries necessary for preparing the beginning and the ending provision. Let's start with the closing of the opening technical provision. As we know, as we mentioned before, the opening technical provision is considered as a revenue, so when it is closed, it should be recorded in the debit side. So we have a debit side, 400 provision, opening provision for potential risk, 200 debit provision for opening outstanding claims or damages. 180 debit account for provision for opening adverse fluctuation. The credit side is just one account, which is equal to 780, which is equal to the credit side revenue and expense department. While the opening technical provision should be opposite to the other one. So the debit side will be equal to the revenue and expense department. The credit side will include the three ending potential risk 300, ending outstanding claims or damages 240, provisions for ending adverse fluctuations 200. Another example, the following are the operations which took place in the fire department on one of the insurance company for the financial year 30 of June. The total the total direct policies issued during the year was 2,250, including 500 long-term policy. This means that the other amount or the remaining accounts for short-term policy. The amount collected of these direct policy or direct premiums was 1,500. The reinsurance premium issued were 700 and have been paid in full. Inward reinsurance premium 1,000, collected 750. Payable commission to producers 50, of which 20 were paid. Share of return of company or commission on outward reinsurance 60. Producer wages and benefits 150. Cost of producing policies 80. Direct payable damages of the year 1,750, paid 1,250. Damages or inward claims reinsurance was 750 and paid 5. Outward reinsurance damages or claims were fully recovered. Provision of opening potential risk 750. Provision of opening outstanding claims 250. Provision for adverse fluctuation 300. If you know that, interest due on bank deposits 130. Of course, this is part or type of other revenues. Profits and returns of securities due 50, collected 30, and expenses related to these securities are 10. Interest and commission of outstanding loans 30 and collected 20. The expenses related to the interest were 8. Value of rental property of income or other sources of revenue was 100 and expenses related to the real estate was 14. Tax stamps collected 16 and paid 10. Accrued investment certificate return 20 and collected 14. Total direct general and administration expenses 50 and the indirect administration expenses was 30. Interest due on the money held by the reinsurance was 70. Interest accrued from the money held by the insurance was 100. Loan provision for doubtful accounts 10. Provision for adverse fluctuation at the end of the year was 350 required. First, calculate the net premium. Second, calculate the provision for potential risk at the end of the year. Third, calculate the net income from investment. And finally, calculate the allocated compensation, or what we mean the net compensation due. As we mentioned before in the previous lecture, in order to calculate the net premium, remember that we have three different types of premium: direct, inward, and outward. As we mentioned before, direct and inward are added together, then the outward premium will be deducted. According to the given, total documents or total policies issued during the year was 2,250. We will add inward reinsurance premium according to the given 1,000. It will give me total premium 3,250. Remember, I have to deduct the outward reinsurance premium 700, so the net premium will be equal to 2,550. The second requirement is to calculate the provision for the end risk or potential risk. As we mentioned before, we have definite or fixed ratios to be used for different types. According to the given or according to the rule, the long-term premium was 500. The ratio for the ending provision for the long policy is 100%, so I'm going to multiply 500. Egyptian pound multiply 100% will give me 500. While the provision for other risk or short term will be equal to 40%. If the total premium or the net premium to 2,550 minus the long-term premium 500, it will give me 1,750. Multiply the 40% will give me 820. So the total provision for ending potential risk will equal to 500 plus 820 is equal to 1,320. The third requirement is to calculate the net income from investment. As we said before, we have multiple type of income or investment. According to the given, the first type of income is the interest from the bank deposits, which is equal to 130. The second type of income is income or dividend from securities, which is equal to 50. But remember, I have to subtract the investment expenses, which is equal to 10. So 50 minus 10 will give me 40. The third type of investment is the revenue investment from certificate, which is equal to 20 with no expenses. The fourth type of income is the loan interest, but we have 30 loan interest and commission. I have to subtract the loan expenses, which is equal to 8. So 30 minus 8 will give me 22. The fourth type of investment is the real estate investment. According to the given, we have 100 real estate income minus the 14 real estate expenses will give me 86 Egyptian pound. The fifth type of income is the interest due from the money held by the insurer, which is equal to 100, minus the interest due on the money held by the insurance, which is equal to 70, will give me 30. So the all sources of income generated by the insurance company will be equal to 328. The fourth requirement is to calculate the net compensation due. As we mentioned before, we have three different types of compensation: direct compensation or direct claims, inward reinsurance claims or damages, and outward reinsurance damage. The first two types, which is direct and inward, are added together to calculate the total due damages, and the third type will be deducted, which is outstanding reinsurance damage. According to the given, the actual or the direct damage 1,750. The company actually paid 1,250, so the net direct damages is 500. The inward reinsurance damage was 750, but the company actually paid 500, so the net due inward reinsurance damage is equal to 250. 500 plus 250 will give me total due claims or total due damage 750. According to the given, there is no outstanding reinsurance damage, which is equal to 0, so the net compensation due or the net damage due or the net claims due is equal to 750. Remember that the outcome of work of property and liability insurance are measured at the end of the fiscal year by preparing what we call it the statement of revenue and expenses for each department, including the property department. All the expenses and income related to each branch are carried over to account for the income and expense of each branch. The outcome of the measurement is summarized in the statement of revenue and expense of each department to balance that what represent as a surplus if the revenue is more than expenses, or a deficit if the expenses is more than the revenue. The outcome of surplus or deficit in the statement of income and expenses carried over to the statement of profit and loss prepared at the end of the year for the general insurance company. Thank you.